This is the general term segment. This is going to be the first lecture we're going to have, and what I want to do is I just want to go over some general terms for those completely new beginners that really don't know too much about the markets. Here's a list of terms that I really need you guys to know before you get started with trading. Exchange traded funds. We're going to talk about all these different bulletins I have over here. I'm sure a lot of you guys have heard about bull and bear markets. Bulls are basically people who think a market or a commodity or a stock is going to go higher in price, while a bear is somebody that thinks a commodity or a stock or a market is going to go lower in price. We're talking about short selling, basically betting that a stock is going to go down. We're going to talk about stop prices, which are placed to minimize our risk or minimize our losses. We're going to talk about the two different kinds of orders that we're going to be placing when we buy or short sell a stock, called limits and market orders. And we're going to be talking about stocks that are in uptrends and stocks that are in downtrends. And I want you guys to be aware of these terms. First topic we're going to talk about here is an exchange traded fund, and basically these are funds that have an accumulation of either stocks or bonds, and then you can trade them as a stock. And they use a technical way of actually pricing these funds. I think that they take the average value of them based on the assets and liabilities of different companies that are inside of a fund. And I just want you guys to know, though, that they're basically the same thing as stocks. You can trade them the same way, but instead of them being individual stocks or companies that you can trade, they're a group of kind of companies that they put into a fund, and you can trade the fund instead of trading stocks individually. I've written down here they can consist of stocks, bonds, or commodities depending on which exchange traded fund it is. Here's some common exchange traded funds that you can trade. GLD, which is the gold exchange traded fund, trades basically the same way gold does. The SPY, which is the exchange traded fund for the S&P 500, basically a fund that holds about 500 companies, or the IYR, the real estate exchange traded fund. There's a bunch of other exchange traded funds out there. These are just some common ones I just wanted to go over so you guys know exactly what we're talking about. For in here, on top here, bull basically means you think a stock, bond, or commodity will go up in price. And I have an example written down here. He's bullish on gold, means somebody thinks that gold will go up in price or in value. Next one we have is a bear, basically somebody that thinks a stock, bond, or commodity will lose its value or decrease in price. I have an example right here. He's bearish on the US dollar, or somebody thinks that the US dollar will drop in price or value. The next topic you guys need to know about is something called short selling. I mentioned earlier it's basically somebody betting that a particular stock, bond, or commodity will go down in price. Basically, you're betting that it goes down. It's basically the opposite of buying. And what you're hoping for is when you short sell a stock, bond, or commodity, you're hoping it comes down in price. Basically, what happens is you tell your broker to sell 1,000 shares of the stock under your name, and then basically in a future time you're going to have to buy those shares back and give it back to your broker. That's why you're hoping that the price drops, because you want to give it back to your broker at a cheaper price than he sold it for you at. Next topic we're going to talk about are stop prices, and this is areas where we place an order to sell out on a stock if the stock drops below a certain area. So imagine if a stock goes up and all of a sudden you buy it and it starts dropping in price. If it drops below a certain price that you did not want it to drop below, you can send what's called a stop order or stop market order, and the your brokerage firm will sell that stock underneath that price or at that price that you sent the order at. So imagine a stock that you buy at $60 and you place a stop market order at $59. If the stock all of a sudden drops under $59, your brokerage firm will sell the stock at 59. And it basically prevents large losses from occurring. Now, remember, if you're short selling a stock, basically it's in order to buy the stock back if the price goes above an area on the chart. So imagine you short sell a stock at $10 a share and you're hoping it comes down. Well, if you put your stop loss for a short sale, it would be somewhere like at $11. It's going to be always higher than where you short sold it. So if a stock all of a sudden you think is going to come down from $10 and it goes to an $11 price, and you put a stop market order at 11 to buy the shares back if it goes above 11, then basically you get stopped out at that $11 area. That's basically what a stop loss is. It just prevents large losses from occurring. Now, there's two types of orders that you can do when you buy or short sell a stock. The first one is called a limit order, and this is basically an order placed with a brokerage to buy or sell a set number of shares at a specified price or better. Now, what does that mean? Let's say a stock trades at $4 a share. You want to buy the stock as it reaches $4.50 and not a penny more. Once that order is given, once the stock, for example, you give a limit order at 450, only shares available at 450 are or better. Basically, what better means, if the stock goes to 450, for example, and you hit buy on the limit order, and then it drops to 449. Well, if you don't get all the number of shares that you wanted at 450, your brokerage firm will buy it at 449. But if you buy, let's say, 1,000 shares at 450, and you only get 500 shares at that number, and it goes to 451, and it keeps going higher with that coming back to 450, the rest of your order will not be quote unquote filled. Now, basically written down here, once you buy the stock, your order is filled. That's just a name that's used to, or term that's used rather, to say that you've gotten your order placed with your brokerage firm to buy or short sell a particular stock. A market order is basically a stock, fund, or commodity that's bought or sold at the market determined price. Now, this is an example of a market order. I want you guys to see how it differs from a limit order. The same stock as the previous slide, basically you want to buy it at 450, but this time the price jumps so quickly past 450 and goes to $4.51. If your number of shares that you wanted were not filled at 450, let's say you wanted 1,000 shares at $4.50, and you only get filled for 700 shares, your market order will buy them at 451 or a higher price until all the shares you wanted are satisfied. Basically, if it keeps going higher in price and you can't get filled until like 453, a market order will buy it no matter what the price is above the price that you wanted it at, until the number of shares that you wanted are satisfied. But if you had basically try to buy 1,000 shares under a limit order and you only got 700 shares, and the price moved up to 451 and it kept going higher without coming back to 450, then your other 300 shares would not get filled, and you would be in a stock for 700 shares at that price, at $4.50 or lower. But a market order will continue buying the stock until the number of shares that you wanted are fulfilled and satisfied. The next two terms we're going to be talking about, the first one is an uptrend, and this is basically a stock, bond, or exchange traded fund that is incrementally increasing in price, defined by higher highs and higher lows. Here's an uptrend that's defined, and what we mean by higher highs and higher lows I'll show you on this chart. Here's the stock price of a particular company called the New York Times, ticker symbol NYT. And basically, when the stock reaches this bottom level, it moves up in price that's higher than this previous high. So now you have a higher high. So basically, the stock price pulled back and bottomed out over here before it moved higher again. Now you have a low that's higher than the previous low, which you see over here by my mouse arrow. Now you have a higher low. The stock moved up, and this area now is higher than this previous area. Now you have a higher high. Pulls back again. This low area is higher than this previous low area. Higher low. Stock moves up again. Higher high, higher than this area. Moves back, higher low. That's the basic definition of an uptrend. It's defined by higher highs and higher lows. I want you guys to remember that. Downtrend is basically the opposite in definition. It's a stock, bond, or ETF that is incrementally decreasing in price, is defined by lower highs and lower lows. And I've got a little picture graph here of a stock in an uptrend. Downtrend is basically the opposite, the basic opposite. Stock starts up here, it moves down, and basically you have a lower high than you did over here. I'm sorry, a lower low. I apologize. This number 2 point is a lower low. It's lower than this low over here. Then, as you move up to this number 3 position, now you have a lower high than that number 1 position. So now you move further down. Now you number 4. This number 4 point has a lower low than the number 2 point. Stock moves up to this 5 position. This 5 position has basically a lower high than this number 3 position. That's the basic definition of a downtrend: lower highs and lower lows. Those are the main definitions I want you guys to remember. Those are the main definitions that we're going to be using in the lectures. There's nothing too complicated about them. Just if you don't understand something, just you can go ahead and ask me in the webinar, or you can just repeat these videos as many times as you want until it makes sense to you. Thank you very much.